The outlook for inflation to me looks very different when you consider different parts of the world. So let's start with the US and then I'll turn elsewhere. The three key policy areas that we're tracking are number one, taxes, number two, tariffs, and then number three, immigration. Immigration, I think, is a particularly important one. We've seen over the course of the past couple of years very high levels of immigration helping to cool off the labor market, helping to bring wage growth back down to more comfortable levels for US policymakers. If we are to see a significant change in immigration flows next year, if that tightens up the labor market, you have fewer workers available, that could well lead to stickier inflation pressures than the Federal Reserve is hoping for. So generally, I think we have to acknowledge that inflation has made a lot of progress in the US. You've come down well away from the double digit levels that we had just a couple of years ago, much closer to target today. But we suspect that inflation could prove slightly sticky above the Fed's 2% target, particularly if the US administration is successful in passing some of its key policy goals. Elsewhere around the world, I think the story is quite different, particularly if you look at somewhere like Europe. A tougher environment for global trade is likely to add further headwinds to growth in Europe. And therefore, as growth cools further, as the economy flirts with recession, that I think is likely to see the labor market cool off further, and therefore overall inflation to cool down even closer to the ECB's target. So I guess really the theme here is one of central banks that are going to be facing quite different environments depending on where you're based around the world. For the Federal Reserve, this probably means cutting interest rates slightly more slowly than they would have previously anticipated. For the European Central Bank, that means now they need to accelerate getting interest rates down to try and offset some of the new growth headwinds.
So we cannot predict things like inflation on a short-term basis. And in fact, if we had to guess, inflation might go to zero over the next 6 months. Who knows, really? But if you think about it structurally, investors in the UK can really see what I'm about to describe. Governments are not focused on the right things. Things like let's drive towards net zero, and that will be disinflationary, has been completely wrong. But the government in the UK has decided to continue to go down this path. The UK now has the highest penetration of wind and solar in the grid's electricity production, and lo and behold, has the highest electricity rates. And the government continues to go down this path. So rates are going to continue to go higher unless the government decides to try and socialize those through taxes, which is also inflationary. That is just a microcosm of what we see happening, whether it's government actions or simple pendulum-like swings in the long-term drivers of inflation, like offshoring to China for 20 years and now bringing all that industry back and bringing it back to domestic. If it was deflationary to send it to China, it's going to be inflationary to bring it back. Or labor power, labor being on its back foot since the late 80s, early 90s. Labor is now reasserting itself, and we're going to have labor inflation. So there are very long-term structural drivers for inflation, and there are facts of life government drivers of inflation, like huge deficits, massive amounts of debt, government debt, driving up rates, likely to drive up rates over the next 10 to 15, 20 years, that also therefore sprinkle inflation into the economy. So we don't know what's going to happen with inflation for 2025, but we're pretty darn sure that inflation is going to be higher than the 10-year average expectation of 2%. We think more like 4.5% might be a more reasonable bogey. And there you can see where we won't invest in global government bonds yielding 4% when we think inflation is going to be 4%.